Hey everyone! Last week we got clarity on which party will hold the majority in the House of Representatives. This was a critical component in determining how the election could impact commercial real estate. If the Democrats had won the House, Congress would have been split, resulting in far fewer policy and economic changes in the coming years. However, the Republicans won control of the House, together with the Senate and, of course, the presidency. And that trifecta victory will substantially impact both the number of policy changes and how big the changes could be. But even though we know both houses of Congress and the presidency will be controlled by the Republicans, there are still a lot of questions. There's still a great deal of uncertainty about which policies from the campaign trail will be implemented, how quickly they'll be put in place, and just how aggressive the policies will be. That said, 3 focus points of the Republican campaign are already influencing the commercial real estate market. The first is tax policy. The renewal of the 2017 Tax Cuts and Jobs Act provisions that were scheduled to phase out or expire in 2025. The second is the implementation of broad-based trade tariffs. And the third is potential changes in immigration policies and the deportation of illegal immigrants. Now, I'm not going to get into the details of all of the potential policy changes this week. But I am going to highlight how just the prospect of these changes are already influencing the real estate market. And the impact is most visible in the interest rate outlook. Since early October, about when the betting odds began to favor the re-election of former President Trump, the 10-year Treasury began to rise, climbing by about 70 basis points since then. There are certainly a variety of other factors putting upward pressure on rates, but I do think the election played a role in the increases. And naturally, the rise of interest rates put upward pressure on the cost of commercial real estate financing. The reasons behind this are multifaceted, but many economists cite the inflationary nature of several of President-elect Trump's proposed policies. Both tariffs and reduced immigration, let alone deportations, could lift inflation. And in addition, many of the tax policies proposed by President-elect Trump could result in an increased federal deficit. Substantively increasing the deficit would likely require increased issuance of treasuries, which could potentially put upward pressure on interest rates. And while some of these policies could boost economic growth, concerns surrounding the risk of reigniting inflation have also brought the probability of Federal Reserve rate reductions into question. A month ago, according to FedWatch, Wall Street was assigning a 68% likelihood that the Federal Reserve would reduce the overnight rate to 3.5% or lower by June of 2025. Since the election results have come in, the probability of rates going that low has fallen to about 15%. So at this point, it's a widely held belief that interest rates will not fall as far or as fast as most investors had been anticipating. But there's still a lot of uncertainty. We don't know which policies will be enacted, how fast they'll be enacted, or how aggressively they'll be enacted. And until we have more insights, lenders and investors will likely remain a bit more cautious. At this point, I haven't seen any credible sources say that interest rates will go up substantively as a byproduct of the election, but there's no real consensus on how much or how quickly they'll go down either. And it will likely take several months for any clarity on policy to begin to emerge. But I want to remind everyone, the long-term space demand drivers for most types of commercial real estate remain sound. We still have a housing shortage. The affordability gap between renting and making a house payment is still exceptionally wide, and that will sustain rental housing demand. Debt payments as a percentage of disposable income are still comparatively low by historical standards, and total savings, including money market mutual funds, is still up by $4.3 trillion on an inflation-adjusted basis compared to before the pandemic. And that suggests U.S. consumers remain in a good position to drive consumption. So as we look forward 3 years or 5 years or longer, the fundamental drivers supporting commercial real estate remain sound. But like I always say, we can't get lost in the news of today. We always have to keep our eyes on the horizon.